morning, everyone. Welcome to today's session of the conference. For those of you from other continents, I just want to remind you it is Thursday. For those of you from North America, I want to remind you it's morning. And it is indeed a pleasure to welcome you again to the conference. So thank you for joining us. We're going to talk today about the state of the global economy and the outlook that the Credit Suisse economics research team has for economic performance, with, of course, some of the implications for financial performance for the year ahead. And the key theme that we're going to advance is the idea that the world, and particularly financial life, which was very correlated for a long period of time, has decorrelated, and that is intrinsically a good thing. So let us get started. We are of the view that the global economy will do a bit better this year than it did last. We're not looking for any booms in particular, but we do think that Europe is emerging from its recession, that the U.S. will be broadly resilient in the face of the fiscal austerity that is being implemented currently, and that the emerging markets environment will, if anything, a complex of countries will, if anything, accelerate some, leading to economic performance that's a bit better this year, and indeed that accelerates as we move through the year, setting a nice stage for 2014, when you will all come back to the conference that we're hosting next year, and we'll talk about how accurate this did or didn't turn out to be. Now, the key development that allows this more sanguine outlook is what we would describe as a decorrelation of economic performance and financial life. How this was brought about is a bit mysterious. We certainly would identify it in time with Mario Draghi's assertions last summer that the euro as a currency will remain intact, that the ECB had the powers and the willingness to assure that outcome, and to quote him, believe me, it will be enough. Now, before that, we went through a phase, lasted quite a few years, began sometime, I would say, in early 2008, and continued to the middle of 2012, in which we worried about solvency. And as we looked around the world, we found plenty of entities, banks, countries, that were not solvent. And solvency, as a risk, is truly catastrophic. That's where real life losses come to pass. But it turns out, if you think about it in a more practical fashion, being insolvent may not be a good thing, but it is in general not necessarily a short-run dangerous thing. What is truly dangerous in the short run is being illiquid, being unable to meet today's obligations with cash on hand today. You can be insolvent for a very long time as long as you have assets, and particularly liquid assets, that can meet today's obligations. You cannot be forced to close the door if you pay today's bills. So this emphasis that we had on solvency risk, which in retrospect I would say was the critical policy error that began, let's say, at Bear Stearns, continued through the mortgage agencies, continued through Lehman, and in the essence, from a diagnostic perspective, was the error initially in Greece. That policy error, that focus of our attention on solvency, led us to the risk-on, risk-off, highly correlated catastrophe insurance kind of mode that we previously were in. But it turns out that liquidity is what actually matters. And again, there's something a bit mysterious about it. The ECB, as we all know, hasn't spent a penny, but somehow managed to refocus our attention on liquidity. And that leads to a more idiosyncratic environment, which in fact we have been observing. And you can see it in these two particular charts. These happen to measure financial outcomes. And you can see that the degree of correlation among equity markets, for example, has come down very significantly. These other correlations, which are correlations among major currencies and so forth, again, very significant reduction in correlation. And you can see that there was this phase in our collective life, and this is what you will all remember and tell your grandchildren about as risk on, risk off. And fortunately, it's been broken. And the first real significant test in this regard was Italy a few weeks ago. And the second test, of course, was Cyprus as we speak. And I think you'll all recognize that as much as one might, in some sense, relish the thought of going back into crisis mode, there is something addictive about crisis, in the same spirit that there's something addictive about adrenaline and performing arts. It's not happening. And that is, on the whole, in my view, quite a good thing, makes the world a much safer place than it otherwise would be. In consequence of which, this is the view that we have of economic activity and its prospects for the year ahead. And of course, no surprise, emerging markets are growing significantly faster than developed markets. That's been going on for a generation, shows no signs of stopping. You'll see that in 2012, we had a shortfall of growth in the global system. A lot of that was the European recession and its impact on U.S. exports, which affected in turn U.S. capital expenditures by business, slowed down the U.S. economy, and of course was part of the story in the emerging market slowdown of last year. But for the year ahead, we're looking for a somewhat better performance. A lot of the detail of this GDP figure in the developed markets is the sequester in the U.S. and the fiscal drag, and we'll talk a bit about that. But on the whole, you can see the global economy doing a bit better and accelerating through the year to give us, at the moment at least, a happier outlook for 2014. I want to do a moment of advertising for those of you who are not yet familiar with the Credit Suisse basic, for those of you who are not yet familiar with the Credit Suisse Basic Materials Indicator, CSBMI, you should be, because our experience with it is that it does give you some informational advantage about the shorter run rhythms, speed-ups and slowdowns in global industrial activity. It's an indicator that's comprised of about 20 very front end of the economy sorts of measures, iron ore prices and railroad car loadings and things of the sort, manipulated with all sorts of fancy statistics. And it does give you, in our experience with it, a bit of an informational advantage, and clearly is signaling that the global economy is, at the moment, having passed through a bit of a surge, in a sort of pause, with a new surge being predicted. This is available through your Credit Suisse relationships. For many accounts, it's available as a statistical measure with Bloomberg as well for your own manipulation. I heartily recommend it, and enough advertising, I suppose, but I hope that it's convinced you that it's something you want to pay attention to. Now, I mentioned that we start, in a sense, by having a somewhat more optimistic attitude about Europe. Frankly, we're more optimistic about Europe than the Europeans. Having said that, I don't want you to run off and think that Europe is at the threshold of a boom. It is simply that the recession process seems to be coming to an end, and we are expecting very, very modest growth for the euro area, but nonetheless growth rather than continued recession. And the starting point for that is the observation that fiscal drag in Europe continues, but is sequentially less intense. By analogy, those of you who perhaps exercise, something that I try very much to avoid, some of you may use weights to exercise. You put weights around your ankles and so forth and run. If you've been running with 20-pound weights and you move then to 10-pound weights, you're still carrying the weight, but suddenly you feel much more energized and can move faster and so forth and so on. In that spirit, the fiscal drag in Europe is coming off. And very importantly, the financial stability in Europe has really been quite resistant to two challenges within the last month that a year ago would have knocked them for a loop. The Italian elections, now the Cyprus problems. We all learned way too much about Target 2 balances last year. I hope it's not a surprise to most of you to know that Target 2 balances are reversing. Money's going back into some of those banks from which it fled. Neville Hill, our colleague who runs the effort to analyze the European economies out of London, very waggishly came up with a wonderful interpretation of the Target 2 problem last year. He said the problem was not whether Spain could stay in the euro, but rather whether the euros would stay in Spain. Well, Draghi has somehow convinced the world without spending a penny that a euro in a Spanish bank is a par instrument. It's a euro. It's as good as being in any other kind of bank. We'll talk about Cyprus in due course in this respect. But again, the evidence is that there has not been any contagion of consequence from that. So the starting point for our story basically is that Europe is going to have modest, but nonetheless growth, following a recession which was frankly more noteworthy for its length than its severity, and of course much more noteworthy for its financial turbulence than for its damage to underlying ongoing economic performance. This should all be taken against the backdrop of the idea that potential growth in Europe is probably quite low to begin with. So if they get any growth at all, they're making some real progress by their standards. Now, having said that, quick observation that on a cyclical basis, the emerging markets are not completely decoupled. Some of you may have heard Robert Pryor-Wansford yesterday make the observation that some of the ASEAN countries seem now to be more decoupled from their export sectors than in any of our previous experience with them. That's all to the good. It's completely natural. It is to be expected. It is part of the maturing process of those economies. It's another way of saying that soon we're not going to call them emerging. We're going to call them grown-up. But it remains the case that on the whole, there is still some cyclical dependence. So if you have a somewhat better outlook for Europe, you automatically have to and can legitimately have a somewhat better outlook for the export powerhouses, whether we're talking about Brazil or Taiwan. And for those of you who are following in hard copy or want to look at this later, we lay out some of the detail of some of these different regions and so forth. But before we get into the U.S. situation in detail, the forecast that we have in mind does not encompass significant inflationary pressures pretty much anywhere. We have some concerns in China, but they have more effect probably on the 2014 outlook than the immediate outlook. We have some concerns in a few other places, but again, nothing that we think will interfere with the posture of policy, which, to state it in the simplest terms, is no central bank will resist growth if they're lucky enough to get it. And for those of you who stayed up in the middle of the night to watch Chairman Bernanke's press conference, that's in effect how I would summarize in a sentence what took him rather a bit longer to explicate. No central bank of consequence will resist growth if they're lucky enough to get it. So against that kind of backdrop, monetary policy remains easy. In Europe, again, to come back to it because it is such an anchor in a way to our forecast, thing that's really quite interesting is that some of the peripheral economies are looking to us analytically a bit like Southeast Asia in 97, 98. Impossible in a way psychologically to be optimistic after you've been through a challenge of the sort that 97 was in Southeast Asia. But it turns out within a year or two, the current account adjustments were underway the hard way. First thing that happens is you have a recession and imports collapse. But the next thing you know, you're not completely dependent on foreign sources of capital, and the local markets start to function again, and exports start to pick up. And we think that, again, not with the kind of growth rates that Asia was capable of and remains capable of, but in spirit, the periphery of Europe looks to us to be in that kind of circumstance right now. So we will move on My goodness. There we go. We move on, having mentioned a bit about the emerging markets, a bit about Europe. Let's talk a bit about the U.S. in somewhat more detail, partly because I live there, partly because the data allow you to explicate themes that are, in my view, quite common, particularly for the developed economies. And the first point I would make about the U.S. situation is that you have to distinguish between the GDP, which is a statistical artifact, and the economy. And rather specifically, last year was a year in which the economy performed better than the GDP. And that was particularly noteworthy if you think about the third quarter of last year with 3% GDP growth and the fourth quarter with 0. And yet, job growth accelerated, car sales accelerated, housing activity accelerated, business capital investment accelerated. So how did the GDP stall? Well, the answer is defense spending. Defense spending in the third quarter was way above trend. In the fourth quarter, way below trend. The average of the two, more like trend. The effect of which is that the GDP had a lot more volatility than underlying economic performance. And intimately related to the sequester, that is precisely what we expect to see again this year. So far, the fiscal drag associated with tax increases effective on January 1st of this year has proven to be minimal, hardly visible at all. That was to some degree to be expected. We did not, from the outset, expect large multiplier effects associated with tax increases on the rich. The nice thing about being rich is if your taxes go up a little bit, it doesn't necessarily inhibit your current consumption outlays. Saving rates and so forth can adjust. And the bad news, so to speak, about the rest of the tax increases is that the poor folks who paid 2% more on the payroll tax are God's creatures like the rest of us, but they don't weigh very heavily in the GDP. And this is a new theme. Having talked to you initially about decorrelation is something I want you to remember from this talk. I'll tell you now the second thing I want you to remember from this talk. The income distribution and the age distribution and the detail of how our population is organized is becoming, for the first time in our lifetimes, a macroeconomic variable. We have a large fraction of the population which is in some sense left out of the economy, and the illustration of that is very visible in how well retail sales have held up, even though some prominent storekeepers who cater to the lower end of the income distribution have been complaining that their customers have run out of cash, courtesy of the payroll tax increase and the slow paying out of income tax refunds. The top decile controls the wealth to an approximation. The top quintile of our income distribution accounts for 40% of consumption outlays. The bottom 3 quintiles also account for 40% of consumption outlays. Only that second quintile is punching its own weight. And I'm tempted to tell you that the second quintile is shrinking in numbers. Now, you know that can't literally be true. Quintiles are always 20% of the population. But that is where the sense of anomie, if you will, in the society is, in my view, most intense. By the way, for those of you who want to know how we managed to re-elect a president in the context of high unemployment and all the rest, look at that quintile's voting pattern. It'll tell you where that margin of electoral victory was. So when you raise the payroll tax, there are indeed some storekeepers who suffer, but it's not going to show up in retail sales taken in the broad. It's not going to show up in GDP to a large extent in the broad, because that chunk of the population gets one person, one vote in political terms, but doesn't vote fully in economic terms, which are in units of $1 per vote. So we expect that the sequester, which is about outlays, about spending rather than about taxing, will have more consequential multiplier effects, and sequentially, it all happens right there. There was no particular restraint on federal government outlays in the first quarter. The sequester officially begins March 1st, but as a practical matter is being implemented, as you might expect, rather slowly. So the big shock to outlays comes sequentially as you move from the winter quarter to the spring quarter. And GDP will indeed, we expect, notice. But that new lower level of outlays sequentially is simply maintained in the third quarter. And so if the economy had any momentum, statistically what will happen is that the third quarter will rebound. And then the fourth quarter, which begins a new fiscal year, has a modicum of greater fiscal restraint in it, which you can see reflected in that very small deceleration that follows. So the economy, in our view, is doing better than the GDP, and that is an important thing to keep in mind. It is arguable, by the way, that in places like Spain, the economy has been doing worse than the GDP, and that too is worth thinking about as you try to make decisions about the well-being of a society, what kind of policies it will follow, and so forth and so on. Now, all of this is against the backdrop, and the backdrop is important. And that is that we do think that after quite a few years of deleveraging of one sort or another, the credit system is beginning to accommodate itself to the new regulatory regime, to the new credit standards, and so forth and so on. But I want to caution you in this respect. Mortgage deleveraging continues. It's slower than before, but the outstandings in that market continue to shrink, and I expect will continue to shrink for quite some time. This has very important implications for QE3. If the Federal Reserve is buying and the market is shrinking, eventually there are problems of delivery. And in my view, one of the key issues for the so-called tapering down of QE3 will come when the Federal Reserve and the market have a conversation that says, we can't keep buying this many mortgages because you haven't got them to deliver. And that's not about policy, that's about market functioning. It will be a bad hair day in markets when they announce this anyway, but maybe only for a day, certainly not for more than 3. And I want you to keep that in mind as we move into the summer and through. I don't expect the mortgage market to pick up a whole lot, and why not? Very simple reason. When we look at the credit data in the US, and you see this in other places that delever as well, nowadays a large fraction of the reduction in credit outstanding is not because people paid their bills, it's because people defaulted on the debts. Statistically, that brings down the ratio of debt to income. But if you've defaulted, you can't say, oh boy, the ratio of debt to income's down. Can I have a new loan, please? We don't do that anymore. That's new news because it didn't used to be this way. Before this particular set of crises that began in 07, let's say, and have persisted in greater or lesser degree since, there was what one might think of as a representative agent in the economy. Sure, there were always very rich people and some very poor people, but a large fraction of all economies' distributions in the developed economies was kind of in the middle. And so if you looked at an aggregate statistic, in some sense you were sampling the average person. Not so now. Now the average can be calculated, but it may not be meaningful. I had occasion to see Paul Volcker on TV this morning. Those of you who were up at an ungodly hour and watching CNBC saw him being interviewed. And I am reminded that if he and I were in a room together, there would indeed be an average height. He really is 6'8", and I really am standing on a platform so that I can see over this thing. What do you call this, a podium, I suppose? But it's not meaningful. It's a barbell distribution that I just described. And the average can be calculated but should not be relied upon. In a similar spirit, when a large fraction, indeed more than half of all the personal deleveraging in the US has come from default and charge-off and forfeiture, and I might add, a lot of that income is transfer payments, and it's pretty hard to go to the bank and turn your food stamps into a credit card. We have 47 million people on food stamps. That figure's about tripled since the recession set in a few years back. It's really very hard to say that the average is as meaningful as it used to be. And this is becoming a new theme at the Federal Reserve. No surprise, in my view, that it's Mrs. Yellen and Elizabeth Duke who are more sensitive to this than some of the others. And if you read their recent speeches, you get a sense that they're kind of trying to make monetary policy in a way that will drag that bottom piece of the income distribution back into the society. And you may ask, is that a proper role for a central bank? But that's a different kind of judgment from the forecast that that's what they're doing. And I don't think they're going to quit. The other feature to this that you want to be alert to is that within this consumer credit that seems to be picking up, there are two basic chunks. One chunk is good news, and that's car loans. And the other chunk is student loans. And student loans is not a good sign. The student loan default data and so forth are absolutely frightening. They make subprime mortgages look like the AAA credits they should have, that some of the rating agencies for a time said they were. The good news from that perspective is that in some sense none of you own car loans directly. The federal government, your student loans, the government makes those. The even better bit of news is that it's not part of the budget deficit because it's an asset transaction. The government claims that it's actually buying an asset in the form of that student loan. So the government borrows the cash from you, never passes it through the income statement, so to speak, so that it's not part of the budget deficit, and then goes and lends it to students who then don't pay. It's terrific. And again, if you think about it, how do you get household formation to be really red hot when kids come out of school with a big burden of student loans that the evidence is they can't pay? It's a little hard to go to the bank and say, you know, I've been thinking about getting married and starting a family and getting a mortgage. And by the way, my wife and I haven't been paying on our student loans lately. Again, it's the distribution of these kinds of phenomena within the economy, within the society, that are the real drag on sentiment, if you will, real drag on the sense of prosperity, the kind of thing that, in my view, will keep the central bank locked into very easy policy for a very long time, because you need larger bull markets at the top end to drag the aggregates along when you're missing so much of the rest of the distribution. Okay, car sales doing okay. Note, however, in this respect that car sales have a sort of 10-year replacement cycle. The reason, in some sense, you have 15 million car sales now is that you had 16 and 17 million car sales 10 years ago. It's good but not great. It's certainly better than the lows. It's like so many other things in these economies. We're doing better, but we're not yet doing well. And that's important because, again, that locks the central banks into these kinds of policies. Housing, I find these just absolutely spectacular, spectacularly interesting pictures. Look what zero interest rates for 5 years does for housing. Not very much. Sequentially, growth rates, dandy. Levels, pathetic. Is the Fed going to stop because they got some growth? No, they're not going to stop till they get some levels, till they get housing starts, not here, but somewhere closer to here. Same is true for jobs. We're missing 3 million jobs still from the previous peak. And if you recognize that the population has grown, even with very, very low expectations for employment to population ratios, you're not missing 3 million jobs, you're missing 6, 7, 8, 9 million jobs relative to where, in some sense, you should have been. And meanwhile, fiscal policy, for reasons we'll look at, is very burdened by the looming old age dependency, so it falls back to the central bank to stay very, very easy for very, very long. I should point out, because I don't want you to think this is all gloomy Gus stuff, it's not, it's just the facts of the moment. It's a bit like climate change, right? It just happens and you have no choice but to acknowledge it and deal with it as it is. The one thing that we do think is likely to be a better driver this year than it has been is the business side in the U.S. if we're right about Europe, if we're right about the emerging markets doing a bit better than they did before, then U.S. exports will do better. And with that, U.S. CapEx will do better. And we do expect that and forecast it, and we think that this sort of thing is definite early evidence that it is underway. And I might add, this is again part of this evidence that the economy was doing better than the GDP during that latter part of last year and early part of this. And you can see, of course, the expectation that U.S. exports will pick up, because if the rest of our forecast is right, it's not the value of the currency that drives export for the U.S. Frankly, for most countries, it's not the value of the currency, but certainly not for the U.S. because, of course, trade is in general denominated in U.S. dollars to begin with. The thing that drives export for the U.S. is the robustness of our counterparties' growth rates. If we're selling to a customer who's doing better, then we make more sales. There's no way really to cut the price in order to induce it, because the price is invoiced in the same U.S. dollars either way. I mentioned earlier something about the distribution of income, urged you to start thinking of that as a new macroeconomic influence. Here's a bit of evidence on that score. We've done some statistical work which asks the question, is the wealth effect, that is the role of asset holdings by households in consumption, is it the same now as it used to be? And we've pretty well convinced ourselves that it is not, and that indeed the wealth effect is smaller since the crisis than it was before. We have always known that the wealth effect from housing is higher than the wealth effect from the stock market. That's true for a long list of reasons. I think one of the most important reasons is people have always expected a certain amount of volatility from the stock market. So if it goes up, it's not necessarily your money yet, because it could go down again. Whereas in all of our post-war history, house prices went up, and then they didn't go back down again. There was very little volatility, and indeed, house prices were permanent wealth, so you could spend out of it. Indeed, it was such permanent wealth that we invented home equity lines to let you take the cash out and go shopping. Well, what was the crisis about in that respect? The volatility of equity certainly has been high enough. For those of you who think about how efficient frontiers get established, keep in mind that for the last 15 years or so, the equity market has had a lot of volatility and almost no return. This is not an asset on the efficient frontier, backward looking. Housing has had volatility for this episode for the first time in living memory. So we are of the view that wealth effects are smaller than they used to be, and this is our statistical estimation of it. And the effect of that, again, is that you need bigger bull markets to get that route of stimulus to the economy going. And who engineers bull markets? Well, zero interest rates help, big balance sheets help, and you can be pretty darn sure that reversing either one of those two is not going to give you a bullish outcome. That would not be a bad hair day if the Fed raised the funds rate or announced that its balance sheet is shrinking. That would be a bad hair year. So, again, something that locks us in. And meanwhile, this is a pair of charts that we actually took from our colleague Andrew Garthwaite. Point I would make for those of you who think that stocks are here and they were here in 2007 and therefore they must be overvalued because, after all, the last time they were here they didn't go up anymore, they went down. I just want to point out, even in a low inflation world, as long as inflation's positive, stock market now is 10% lower than it was in 2007 in real purchasing power terms. So right away you got 10 points you can play for. And corporate profits are 30% higher now than they were then. So in some sense it's 30% cheaper. And I find it very difficult to resist the idea that the stock market wants to go up. And the fact that Larry Fink said it yesterday makes me even more confident. Because if he puts his balance sheet to it, it's more significant than my putting mine. And corporate profits are very high as a share of GDP, which is, of course, another way of saying that the income distribution within the society is not as it used to be. So I urge you, take these distributional items into full account. So last year we talked about this. I'm just going to repeat it. Low interest rates for a long darn time, technical term. First, because it's easier to restrain growth than to boost it. This is really pretty remarkable stuff if you think about it. This is the current business pickup. And this is where, in some sense, you ought to be based on our history. Probably part of this is that potential growth has come down. In the same spirit that China tells you they're not a 10% player anymore, they're a 7.5% player, the U.S. is probably not a 3.5% growth country anymore. It's probably in the 2s. Some of that gets reflected here. But still in all, that's pretty inadequate considering the budget deficits and the monetary stimulus that was required even to achieve this. Lots of missing jobs, et cetera, et cetera. So just to repeat the point, monetary policy and, for that matter, fiscal policy are really much more efficient at restraint than they are at stimulus, particularly when the income distribution gets skewed in this fashion. Worth keeping in mind. The Federal Reserve says they're going to keep doing this until they get a substantial improvement in the outlook for monetary the job market. And I know that there's this fixation on a 6.5% unemployment rate. For those of you who are economists or like to wander around the blogs, the behavioral finance people, the behavioral economists, are absolutely appalled at the fact that the Fed said 6.5. Because when you cite a number in the context of a long list of words that qualify it, it is in the nature of the human mind, or at least brain, that the only thing people notice is the number. I try to do this in bonus negotiations. If it's a good year and so forth and so on, then I want that. And I'm hoping that the only thing that gets remembered is I want that. The Fed should never have done this. It's a gigantic mistake. The only good thing about it is it gave about 2, maybe 3 weeks of work to every Wall Street economist, because we could write papers for you about how many months of job growth at a given pace it would take to get to 6.5. But I want to tell you, when they get to 6.5, notice what else they say. The unemployment rate, payrolls, the participation rate, the employment to population rate, job finding rates, growth momentum. That's the set of qualifiers. And now I want you to notice the most important, and this goes again to what I think is the new innovation in the thought process in central banks, this idea that monetary policy has a duty, so to speak, not to the GDP or the aggregate economy, but to some distributional issues. Mrs. Yellen's most recent speech, it will be years before many workers feel like they have regained the ground lost. I don't want to start singing Kumbaya, but some of you may remember a song that you heard probably way too much in bars for a period of years, Feelings. It's ridiculous in its own way, certainly outside the mainstream way we've been trained to think of the goals and roles of central banks. But then again, this is the person that most people think will be the next chairman of the Federal Reserve. And I find it hard to disagree as a participant in that society, even though I'm not so sure that monetary policy is the right place to be trying to deal with these issues. So that's that set of issues. The second thing, we talked about this last year as well. This is starting to be, again, something that the central banks are becoming cognizant of. If you leave rates here for long enough, then these are the only assets we can own, because all the juicy coupons from the past have matured or been refinanced out of existence. And so our balance sheets are loaded up with low coupon, long duration assets. And if the central bank exits and starts raising rates, then our deposit costs or our other liability costs go up. We're stuck holding the old assets, many of which will have negative convexity in that circumstance. They'll get longer on you. And the next thing you know, the whole financial system looks like a savings and loan association from the 1980s. And I remind you how that ended. And I fear that this would end a lot faster than that. There's only so much regulatory forbearance this system nowadays would be willing to give to banks that found themselves upside down with respect to their net interest margins. So they're starting to understand that once you're here, there's a kind of negative convexity to monetary policy. You've got to stay here for a long enough period so that the exit can be extraordinarily drawn out and gradual. And Chairman Bernanke's been hinting at this, closer than hinting, saying that maybe the real trick to this is we won't sell any assets at all. We'll just hold them till they run off. That means that you got balance sheets like this for 30 years, because that's what they've been buying, long bonds. And finally, just a quick point on we literally looked at this picture last year, updated it by 1 year just to show the point. The budget in the US, the same is true for Japan, the same is true for the UK, the same is true for most countries whose public finances are reported, has had a pattern like this. GDP's grown over the last period of time, it's true. Spending's gone up a lot, revenues have not. And debt service expense, unchanged, because interest rates have fallen as fast or faster than the debt has accumulated. What happens? There's debt service expense, right? You can see in 1999, when the public debt of the United States was a third of what it is today, debt service was $230 billion, and in 2012, with 3 times as much debt, debt service expense is $240 billion. By the way, that difference is about the size of what's needed for Cyprus. Puts things in perspective. Because interest rates came down. Well, what happens if you reverse that polarity? Well, this is what happens. If you let interest rates go up, then interest rates become the budget. CBO projections, 88% of the budget deficit 10 years from now is to pay interest. That means you have to raise taxes to pay interest. Or you have to cut programmatic expenditures to pay interest. Or you have to come to Asia and borrow the money to pay interest. And you layer that on top of what you really need to spend the money on, which is the looming baby boom generation. That's not looming in Japan, that's clear and present, but that's still looming for the US, and in different orders of magnitude is either present or looming in Europe. And in 2025, give or take, entitlements plus interest absorb 100% of the revenues of the tax code. That means if you want to have an Easter egg hunt at the White House, you got to ask somebody in Beijing or Tokyo to lend you the money. More importantly, if you want to have an aircraft carrier, you have to ask somebody in Beijing or Tokyo to lend you the money. And that's not a trivial set of statements. That's a very different definition of self. And for those of you living in Asia, you are living with that redefinition. So it gets very hard to imagine that the Federal Reserve is going to raise interest rates to do this. To an approximation, last year the Federal Reserve's profits were $100 billion. The Federal Reserve is organized basically as a private corporation with a 100% tax rate to the US Treasury. So the $100 billion of profits went to the Treasury, made it possible to have $100 billion less of taxes than otherwise, or more programmatic spending than otherwise, or less budget deficit than otherwise. And if the Fed raises rates, then right away that $100 billion disappears. And $100 billion over 10 years is $1 trillion. And $1 trillion is the whole sequester that everybody's fighting over. So it gives you some flavor for how locked in, it seems to me, the budgets and the central banks are. And again, in Japan, this is absolutely clear and present, and the language for it could not be more straightforward. The Prime Minister says to the Bank of Japan through the newspapers, and I suspect in private, if you do what I say, we'll keep the law that says you're independent. Independent central banks is a luxury. It's a luxury that we were all able to afford in the decades, from the end of World War II until 2007. It's a luxury that most of us cannot afford anymore, in my view. And the Bank of Japan is subject to the most explicit such language, but you're going to hear more hints along these lines, and certainly observe more behavior along these lines, if I'm right, in the other central banks as well. Or to put it in plain English, inflation targeting is so 1980s. So, This is the real set of issues everywhere. This is why potential GDP growth is coming down around the world. And it's not going to go away. It's, in fact, going to accumulate as we move forward. But having said that, as I said at the outset, we are, from a cyclical perspective, relatively optimistic about this year, and particularly about its profile as we move through the year, setting a better base for 2014. And the financial implication of this, in my view, is quite straightforward. Interest rates aren't going up. Bonds have probably done for you what they can in the sense of how much lower can yields get, which leaves the field of dreams as the asset class of choice. That's not how Larry Fink phrased it, but that's what he said. So I leave it there. There are a few minutes available for comments or questions, and then on to the rest of the program of the day. Sir.
Neal, could you comment on the whole concept of energy in the US being cheaper than the rest of the world? If you just think of it, US is probably the only country in the world which has $20 oil.
Yes.
In some form or the other. And how does that play into your forecasts, and what does it mean for the next 10 years?
I think the starting point is that everybody thinks of that wonderful Macaulay phrase about economics being the dismal science, and it is expected that I will have some dismal perspective on it, but I want to tell you, cheaper inputs is a good thing, period, full stop. And the science of economics is about managing scarcity, but the goal of economic policy and economic life is to overcome scarcity. So more abundant energy, cheaper energy is an unambiguously good thing, and I think that's the starting point. What you have to be a little careful about is to think that it solves all problems. Energy extraction is a very, very high productivity endeavor, which means there aren't a whole lot of jobs in that. And to the degree that it makes manufacturing more competitive than otherwise, manufacturing is a very high productivity endeavor, so there are not a whole lot of jobs in that. And I sort of don't care how cheap energy gets. I don't think Americans as an economy are organized now to go back to T-shirts and socks. So what manufacturing does come back to the US is going to be even at the higher end within manufacturing, which means even less job intensive. Now here's a statistical anchor, so to speak, to this point. We had a big energy boom in the late 70s and early 80s associated with the Shah of Iran and the second OPEC oil shock and all the rest. The single biggest quarter of contribution from energy drilling and exploration and so forth to the GDP was during that period. It was 0.8%, and it lasted one calendar quarter. So is cheap energy a good thing? You bet it is. Is it going to change the whole world inside out, et cetera? Probably not. And I think that's the correct perspective. It's good, but it's not a panacea. And I think that's, I was not able to participate in this panel, but there was a panel on shale gas that Rick Deverell and some others did on Monday. And I think that would be the kind of conclusion that they would have presented as well. If there are materials from that, perhaps those of you who are interested can get access to that. We have time for one more. Please, sir. Question for those who didn't hear it is, when do I expect the velocity of money, or the money multiplier, to start picking up? We have had in living memory basically only 4 shocks to the money demand function of consequence. One was in the US and more broadly in the 1930s, a negative shock in the sense that people got scared and they wanted to hold money. That was followed in the mid-40s and early 50s by a positive shock, because coming out of World War II, you'd had full employment with consumer rationing. So everybody got a paycheck and nobody could go shopping, and there was just a lot of M2 in the household balance sheet. And that gave you enough money, so to speak, to finance the 50s and 60s expansion. And then, of course, we had Japan. Not so much the early 90s, but the late 90s when the banks got into all that trouble. And ever since then, pretty clear that the Japanese hoard cash. And the US in the immediate Lehman context. So the evidence for that is that when you get shocks of this magnitude, they tend to have decadal or multi-decadal kind of decays. The 30s didn't end until you'd gotten to full employment and consumer rationing and reliquefaction. The reliquefaction didn't give way until Bretton Woods broke down, basically, a 25-year or so stretch. The Japanese are still there 15 years later. We're still there 5 years on. So the answer is a technical term, a long darn time. Thank you all very much. I much appreciate the attendance and your courtesy. Thank you.